Welcome everyone to our Strategies for Success seminar.
Here,
Yeah, pull up a chair, come up close. This is our second seminar in 2014. I'm happy to see some familiar faces, people who have been here before, and then some people who are here for the first time, but also familiar faces, so welcome. I'm Andrea Roche. So we're going to jump right in. We introduced our new logo when we moved. Well, it took us a year, but that's our new logo, Helping You Grow. And so, the idea behind the seminars is to provide information and just share information, help people with a variety of different problems, growing your business, growing your personal finances. And so we're happy that you're here to help, and we're here to help you. Okay, so our first speaker this evening is John Cofiell. I'll let you introduce yourself.
Thank you very much, and thank you for coming here this evening. I'm John Cofiell. I'm the President and CEO of First Rate Financial Group. We're a real estate finance company here in town. I've been doing this for almost 28 years, so I'm still at it. We do primarily residential, 1 to 4 units. We do some commercial, a little bit of everything. But what I really wanted to talk with this evening is getting into how it does something that I do help everybody, whether it's purchasing or refinancing a home. Growing up, we have no idea, and I don't know about you, but at this age, I wasn't even thinking about finance, okay? Basically, you got an allowance, and at the end of the day, if I got a quarter, it's what can I go run down to the 5 and dime and get a candy or something like that. It's not until we're getting through school and we're getting out of school and now you're starting to rent and you've got student loans and then you get a car payment and all of a sudden you're learning how to budget trial by fire. And there's not something in school right now that is actually teaching you how to do the checkbooks and everything else, which is really a shame. So we're all learning on the fly. And what ends up happening is that at some point you're having to come to some professional to get some advice. You're trying to figure out exactly where is all your money going to go and trying to get your arms around your budget and your financing. A lot of people, they start out and they're looking for something that they need, that they want, and whether they can afford it, they really don't realize it until after the fact. This is something that I would need and want, okay, but it's not in the budget. At the end of the day, people come into my office and they're wanting help. If they want to purchase a home, we help them purchase the home. If they want to refinance, a lot of times they're coming to try and save money or cut their budget or cut the time frame. So the best analogy that I had was a bunch of saws. And my whole thing about the saws is that why are there so many? They're all designed to do the same thing, cut something, okay? But they have a certain purpose. Coping saw, hack saw, miter saw, they're all designed for a specific purpose. So mortgages are very similar to that. They're all designed to cut something, whether it's the time frame or whether it's your payment. And so when someone comes to me, that's what we're looking at. It's not just someone coming in saying, I want a 30-year fix. It's like, right, okay, but is it the right tool? What are you trying to do? The first thing I want to know is that what's going on with you. So we're looking at the overall picture, not just what do you want. Andrew doesn't like spreadsheets. I'm a numbers guy. I'm sorry. But what I do, it's all about the numbers. We actually look at the debt to income ratios. I hate to say it, but when you talk to a lender, that's one of the things that they're going to throw out. You are not supposed to have too much debt. Okay, this is your income, so we'll allow you to have a certain amount of debt, and if you have too much over that, you're not going to get the loan. There's credit scoring. Okay, more numbers. Okay, what is your FICO score? A lot of different numbers when we're looking at whether you're going to get the loan or not. This is an example as to when a client came to me after he'd already been declined by 3 other lenders. He'd went to the lenders and every one of them started the process. He paid for an appraisal and they ended up getting denied. And so he finally came to me and I threw this up on the spreadsheet for him and I said, I don't even know why you started. Why did that loan officer even get started? You can't get from where you are to where you want to be unless they've done this. And right now you're too high. These debt to income ratios right here, it's hard to see if you're in the back over there. Those are 79.5% of his gross income. We don't want you to be over 43%. We have a long ways to go. They want to stay in their property. By the way, he's 80 years old. His wife is 65. And this is what they're dealing with. So the house is worth 1.1. They owe about 640. They've got some car payments. They have $86,000 in credit card debt. They did have 1.1 million in the bank that is also, some of it's in annuities and stuff and paying them an income. That's part of that income. But overall, they're bleeding and going downhill. And they're losing the house, they're losing everything, and they don't even know it. Or they know it, basically, and that's why they're trying to seek help. So the first thing I did is I said, we need to figure out, like, can we keep you there? I guess the wife really loved this house, wanted to stay in the house, so I said, okay, well, the first thing we're going to do is that if I took all this debt, wrapped it in with a $109,000 loan, and gave you a $195,000 equity line, we're saving $1,700. Sounds like a no-brainer, that's great. But the problem is, they're still at 65%. It's not good enough. No matter what, they're not going to get that loan. So that's not even an option. So when I came to him, I said, the best thing to do, really, if you're going to do anything, is just keep what you have, take $86,000 from your 1.1, pay off the debt, your $2,200 in savings. Saves you right there. You're not getting, that's about 25% return. Not getting that. Actually, it's more than that on their money. So that is the best use of that money right now. You still have over $1 million sitting in the bank. That's the first thing I would attack right away. Get rid of it. Their mortgages are interest only, so they're not attacking any of the principal on this as well. And the other thing that nobody's ever told them was that this mortgage, the first, in 18 months, is going to recast, and he has to start paying principal and interest. But now over 20 years. And so when I showed him what that payment was going to be, he just about choked. Okay, because there's no way for him to get, at this point right now, another conventional loan, and he's got a reset liquidity problem happening within 18 months. He's going to lose his house. So I said, you got to think about something, because right now I can't get rid of enough debt. And if I take these two loans and give you a principal and interest payment, I'm making it worse. I'm increasing your payment. So I told him, I said, you need to really sell your house. And I thought the wife was going to cry. I said, you got to percolate on this a little bit. But I said, right now with where you are, I said, your house is not a good solution for you. You sold your home, 1.1. By the time we get rid of the real estate fees, closing fees, they got $1,039,000, take out the mortgages, they still have $400,000 left over. So if you can take that $400,000, I said, you can go buy a house. Go buy a 750 house. Okay, put $375 down. Rate of 4.5 is where it was at the time. Your net payment is $1,900. His payment prior to that, if you look at it, interest only was $2,090. Okay, and now he just has $1,900. So there's some more savings there. But the problem is when we were doing the numbers, that wasn't working. So I said, okay. Then I think what we need to do is, if you look at this, the 1,900, I'm still at 56%. So the conventional loan's not going to work. So I said, with your age, we're going to do a purchase, but we're going to do a reverse mortgage. Now you don't have a payment. And right now, today, there's no qualifying for a reverse mortgage. That is going to change. So he's got a very limited time, because the government is trying to make it that every loan you have to have this ATR, which is ability to repay, and the reverse mortgages are going to follow underneath that very, very shortly, so you need to get going. This way, by getting rid of that, getting rid of this, he's almost $4,700 less than what he's currently doing today, and his ratios are 40%, he's back in line. And that was the solution. And he sat there and he came back later after he went for about 3 or 4 days and came back, and he actually sat there and thanked us. He says, you're the only one that went through this process. and explained it with the numbers to say, this is what you need to do. He goes, I get it. So unfortunately, they're going to have to sell their home, but he says, if I don't sell it now, I'm selling it little by little, and I'm going to end up selling it and not have the money to get where I need to be anyways. So at least you were honest with me. Yes.
Why couldn't he do a reverse mortgage on the house that he was first in that he wanted to stay in?
Very good question, because we did look at that. Okay. To do that, the reverse mortgage, the way they look at reverse mortgages, it's your age, the value of the property, how much you owe, and the zip code that the property's in. And the benefit, because they take the age of the lowest occupant. So even though he's 80 and would actually qualify for a higher benefit, they take the wife who's 65. So the benefit was only $325,000. So at the $1.1 million, he not only has to pay off the $86,000, he has to bring, because remember he owes $640. Okay, he's got to get down to $325. So now more of his assets, that 1.1, has to be used to buy down to get to the 3.25, and those assets are part of his income. There are annuities and stuff like this that are paying him income, and now I'm losing that. So everything gets out of whack again. So when we started going through that process, he understood he doesn't have a choice. His choice, I don't care how much he loves his house, he's got to get rid of it. Reverse mortgages, typically you're using those reverse mortgages if there's no other options. It's not the option that I would choose for everybody. Like I said with the saws, I mean, we're using the loans to get to an end result. And the reverse mortgages, they take a long time because there's a lot of consulting with accounting, with legal, with heirs. There's a lot of things that people that we have to involve when you're doing a reverse mortgage. And it's also counter of what you would normally be doing because we've been told all our lives to pay it off. And now it's going the other way. And also, there is times when we want to use this solution. Okay, and in this case right now, it's really the only solution. There's still plenty of money that's going to be left over for heirs. Okay, so he's buying the place, it starts at $325. So let's say it's 10, 15 years later, and he, that instead of $325, he owes $5 or $6. Okay, well, he bought the house at 7 something, maybe with appreciation it's at 8. There's still a little bit of equity in there. If the heirs want it, they'll sell the house, or they can actually take it and refinance it into a conventional. And he still has the other assets that we didn't touch. So again, it was just a win-win solution for everybody. There's a lot of things that we do on trying to get people from point A to point B. There's times when we have to take 2 steps. For example, we are consolidating a lot of things. A lot of times when you're consolidating a first and second loan, if the combined loans get over $417,000, you get into another bucket where Fannie and Freddie, everybody knows what that is. They're the agencies that usually buy all these loans. It doesn't matter what bank you go to. There's a 1 point in fee, which if you're looking at a $600,000 loan, that's $6,000 is charged for combining those two. Nobody wants to pay it, so the rate goes up. So there's times when, let's say someone has a lot of debt, so their credit score is down. The credit score can affect the rate that you end up getting. So I'm getting hit for the interest rate because of the debt. I'm getting hit for the interest rate because we're taking cash out. So I'm having to give them an elevated rate that I really don't want to give them. So I may do that to combine everything. Once I wait 6 months, the debts are gone, the credit score comes up, it's now a rate in terms. So 6 to 7 months later, I go back and I refinance them again. And if nothing's changed in the rates, we get a lower rate because I don't have all those hits and add-ons to the rate. But I'm always looking at what's the end all of where I want to be on the loans for the client. At the end of the day, you have to remember, most important thing is you got to spend less than you earn. So, anyways, is there questions like this? I mean, it's kind of a quick synopsis of how we work differently. I mean, honestly, most loan officers, when you go, they really don't do this. They don't go through the steps to figure something out. You're just calling up and here's what's the rate? What's a widget?
So a lot of times people will come to us or to you and not have the $1 million in the bank and have similar kind of debt to equity ratio. But what do you suggest for someone who's in kind of that situation where there's not $1 million in the bank, so they can't just pay off the credit card?
Well, there's we're looking for, if they don't have that to pay the credit cards off, okay, and if there's no equity, that's tough. I actually had someone that, what we ended up doing is we borrowed against a 401k. Okay, you can borrow against a 401k. And we used the money for that to pay off the credit cards. And then what we did was the payments on the credit cards, we looked at how fast that savings, because we want to take those dollars and apply it against the 401k, and how fast do we pay that back. And then once we pay that back, and it's all about budgeting, now that we've got this much money, what are you going to do with it once that is paid back?
So if you borrow against your 401k, does that count against your debt to income ratio?
No, because you're paying yourself.
You're borrowing your own money,
Yes.
but you still owe it back to the 401k.
Correct, but they don't, because it's a loan against your money. It's kind of like a margin account.
Right.
Okay, you're borrowing against your own money. So if you don't pay it back, they're going to sweep it. Okay, so we're not taking that into consideration as a debt to those ratios.
I always thought in reverse mortgage you had to live in the house for a while. It's really just the equity that's in it, plus those other things, but.
Both. Okay, a reverse mortgage, because it's going backwards, you have to have a lot of equity. Okay, so because it's going backwards, it's growing. And we actually looked at an option. There's another reverse mortgage that we don't have to have the spouse on it, because we wanted to see if the benefit for his age, because he's 80 years old, but the rate went from where we are now, like in the 4s, to like almost 8.9%. And I kind of went, no, because in like 7-8 years, he's going to owe like 1.2. So I said, he's gone, but now she doesn't have the house to live in. So at the end of the day, we really wanted to have something that, statistically, he'll probably go before her, that if he does pass, when he does pass, at least she has a house to live in. On a reverse mortgage, it's only good as long as you're living there. That is a good question, because if you do a reverse mortgage, you cannot move out. If you move out, it's due and payable. So if someone goes to an assisted living facility, if the wife was still there, it's fine. Okay, so if he had to actually go to assisted living, as long as one of those two is living there, it's not due and payable. But if both of them are not living there, then the heirs or they would have to either sell the house or do something with it, because the loan has to be paid. Thank you.
What I like about working with John is he looks at the whole picture. He's like, I was working with one of my doctor clients who was trying to buy a home, and he has a lot of property and he has a lot of loans. He has a lot of money in the bank, and he was with B of A for 40-something years, and he thought he could just walk into B of A and they go, oh, sure, doctor, here's your loan. And he found that his ratios were out of whack. They never really explained why, but they turned him down. And so he had several long conversations with John, but I really like the way that John thinks outside the box and looks at the whole picture, which I don't think many of the mortgage people out there do. So he's a good person to know.